Welcome to the Aramir Trading Group 1 meeting. Today is the 28th of June, 2021. So welcome everyone. If you haven't been here before, welcome. Trading Group 1 is a place for traders to come together and talk and ask questions and get ideas for improving what you're doing. So nice to have you here. And Dave and I were just talking about the weather. We're feeling a little bit guilty here because we're getting all this rain, but the southwest of the US is just dry as a bone. I don't know. I hope they get some rain. Okay, so I see Dave's here. So Dave, we were talking. How are your Flex and Dreamlifter trades going?
Oh, well, let me I gotta take a peek. It's been so hot here that I literally just walked in and we wanted to get a little walk in, and so my wife and I literally just walked into the house. So I don't really have my screens up yet.
Okay.
But basically, I've got but in general, I've got the Flex trade on right now, which we put on last let's see, on the 24th. So what's that? And we put it on basically right at the end of the day on Thursday.
Mm-hmm.
So it's basically just been on basically Friday and now today. And right now, okay, here's my so right now it's basically we made an adjustment to it on Friday, which basically took care of any upside risk. And so now it's just playing to the downside, and it's basically just kind of breaking even right now, just after a day. So now we're just waiting for the kind of the natural thing to occur, which would be just the T+0 line to start, popping up a little bit, and just looking to make kind of our so far it's been pretty much kind of weekly money from this. So so it's
These are pretty short term, right? Couple days.
The ones that we've had on so far, since the change of kind of since we went to Flex 3.0, the trades have been anywhere from, I would say, 3 to 7 days.
Okay, fairly short.
And that's 3 to 7 calendar days. So actual trade, I mean, that's not counting, that's counting the weekends and stuff like that. So
Sure.
like, for example, my trade right now, we put it end of the day. I mean, we put it on the trade 15 minutes before the end of the day on Thursday. So, but right now it says I'm 4 days into the trade.
Oh, right, of course.
Because you got, yeah.
Yeah.
So
is that something you can show us? Just get a quick visual.
Yeah. Let me, I'm just, like I said, just getting things started here. So let's see, share my screen.
I see O&E.
Okay, great. So yeah, so here's our current Flex trade. Like I said, we put it on Thursday, and we just made one adjustment on Friday, which was basically when we started the trade, we had 6 contracts here. And then on the end of the day, which was end of the day on Thursday, then end of the day on, or sometime during the day on Friday. Let's see, actually, I think I did a little bit earlier because, let's see, that would have been the, yeah, oh no, 12:30. So at 12:30, we made an adjustment and rolled 4 of those down. And then right now, like I said, we're not, well, the risk to the upside is $10. So we're, the expiration line here is at, $9.50.
So what's the plan for making money on this trade?
The
I mean, assuming it doesn't go lower, of course.
Yeah, I mean, if the market, well, it's pretty easy, because if you take a look and say, well, if the market stayed right here, okay, basically, if you just take a look at what would it be, towards the end of the week, as you would get out here, okay, without doing any adjustments, okay, you'd be sitting here, at around a little bit less than 1%, right where we're standing right here. Obviously, if the market comes down, then we'd be taking advantage of that. But typically what we do is I usually look here a day ahead, and then I go through a set of criteria, which would basically say how much risk can I take to the downside. And then if I can, what I'll do is just, the attempt is to try to you know, either keep on raising the T+0 line at expiration up, or if we see that, you know, the market is up kind of at really all-time highs, and, you know, it looks like the greater possibility is that we may be coming down. Well, then, as I showed here, you don't really have to do too much, because, you know, the T+0 line will naturally start coming up like this, and you can, you know, make some money just based upon, you know, the market coming down. But if it's not coming down, then we kind of go through the process of raising up the T+0 line,
The expiration.
the expiration line. You know, so basically you can go and, you know, you can see here, you can raise it up, and here. So here, if we're able to take the risk to the downside, and what we do is every day I look at this and assess the risk. Plus, there's other things that we're taking a look at as far as how far are we away from the money. So for instance, in this kind of a situation, we may very well go and depending upon what the market does at the end of the day today, usually I like to keep these shorts at somewhere above 16 negative delta. So now we've dropped below that. We're at -12. And basically what that means is that, you know, the ability to be able to earn money in the trade goes down.
Right, it's diminishing.
Right, so I've got a set of criteria which I basically use to say, okay, and it's also taking a look at the market. Okay, because obviously, even if it's at 12 now, I mean, if the market comes down, it won't take much for this to pop up to 16. You know, it only would take a matter of, you know, 10, 20 points or so, which, as we know, could happen pretty quickly. And then it wouldn't necessitate you doing anything to the downside. So basically, there's a juggling act of, you know, maybe 3 or 4 different sets of criteria which I use to be able to go and, you know, because you're weighing what the market's doing, you're weighing the risk, you're weighing, you know, building up your profit in the trade as soon as possible. And of course, you know, we're not trying to make huge amounts on this. We're only in it for a few days. So, you know, the ability to, you know, just, I mean, look at today. I mean, today, you know, we've got 145 theta on a $16,000 position. So, you know, if you're only looking at making 1.5%, but remember, sometimes it could, if the market, you know, depending on how the market moves, you could be making somewhere between, you know, maybe 1% to 4%. So, but that's each week.
Right.
So
it adds up fast.
Well, it does. And, you know, people will say, oh my gosh, you know, 1%, that's not much, you know, but it's like, oh, but that's, you know, if you did it every week, that's over 50% a year.
Right.
So
without compounding.
Right. Okay. So I don't get, we're not trying to stress this too much. And because we know that compared to other trades out there, i.e., you know, boxcar trade, and other trades, you know, this one I would say is kind of more to the aggressive side because of the time that we're in the trade and how close we are to the money. Okay. Right. So, you know, each one of the trades, I mean, I think they're all good trades. They just take on, you know, and actually, you know, I don't know if Tim's on, but Tim and I talk about this a lot because, you know, classically, many of the things that he would be in are, you know, similar, but they always tend to be a little bit more conservative, and mine tend to be a little bit more aggressive. And that's just our trading style, you know, and there's nothing wrong with each one. It's just a matter of, you know, it's where you feel comfortable.
So, yeah, I don't see Tim, but yeah.
Yeah.
I did have, this is kind of off the track a little bit.
Yeah.
I started using ONE again recently, and hadn't used it for a while. I set up the T+N lines. There's like 4 or 5 of them, but how do you get it back to like 1 or 2? I couldn't find it anywhere.
So right
there it is, line. Okay.
That's so if you could go here.
I got it. It's so easy.
You know, I was fooled by this for a long time because every time I hit this button, it didn't show up here on the screen. It would show up on my other monitor. Oh. And I was like, how do I get back? You know, and it was like, I had to go look at my laptop because the screen that you're looking at is a monitor, you know, a bigger monitor. But this usually would come up on the, you know, the other thing. So this is kind of like, you know, if you want to take if you take a look at this, this is kind of like taking a look at, you know, I think the way that Dan Harvey takes a look at it, in, with
with toss,
the day lines, okay?
right?
And this
Day
is
step lines.
day step lines, and this is basically the same thing. So you could say, okay, well, here we are. You can kind of, zoom in. I'm just moving the whole screen here to the left, so I know it kind of crunches up,
Right.
but you could say, okay, well, here's the 29th, and here's the T+1, T+2, T+3, and it shows you right here. Okay, and if you change to it, you can actually see down here what it would be. And here's T+2. So it goes, and so on and so forth.
Yeah, the old CEO of Liveball, I think before they were bought out by CBOE, she was considering not even putting the expiration line on their charting.
It's funny, Tom. It's interesting. I've played around with this, and because it's very easy to kind of go back and forth, right? Just
right.
just right click and show expiration line or unshow it. And I think it's probably just because I've been doing this for 13 years or something. I'm so used to seeing this.
I know, right?
I'm so used to seeing this that, like, without it, I felt lost. It's like,
Yeah.
oh, wait a minute, you almost felt like, you're taking off your training wheels,
Right. Or
So,
where's the structure? Where's the bones?
yeah, I mean, I know it's kind of silly, but I think that's just because of what we get used to.
Right.
So, but I have been going back and forth with this just because sometimes it's nice to be able to see, just the lines, or I would go into Thinkorswim and do the same thing. But, I mean, I'm looking at this and saying, okay, for me, the easy thing is saying, okay, I try to keep this thing simple and saying, oh, sure, could you go and put, maybe, a couple days on here or something? Sure, you could do that. But I'm sorry, you could go put a few lines on here. You can, but I try to keep things a little bit simple. And if I want to see what, I'm sitting there saying, okay, here's today. Okay, here's today. And you say, my gosh, this is kind of crazy. So then you put your thing back in here and, okay, this looks more normal,
Yeah.
And I say, okay, what's tomorrow look like? Well, geez, you can't see too much here. So you just kind of scooch this in a little bit. I wish we could get rid of this box down here.
Oh, yeah.
Or move it or something, because it's right in the way. But anyway, I take a look at here and say, okay, if I look tomorrow, it's like, okay, we're sitting here right now, basically flat. Okay, down a little bit. Okay, but I think the vols are vols are up. Vols are up here a little bit.
Yeah, not much, a little bit.
Yeah. They were up more before. Up to the VIX was up to 1637 earlier. So take a look at here and saying, okay, we're bouncing around break even, which is fine. We're flat for the day. And so basically, classically, I'll look, and say, what do we look like tomorrow? And what I'll do is I'll do this towards the end of the day. And I'll say, okay, what kind of risk can I take, based upon what could be happening overnight, and I go through a set of calculations. And then depending upon that, I'll go and say, okay, well, let's see what, moving a couple of these things down, and okay, what kind of risk does that give me going into tomorrow? What kind of leeway does that give me? And, I look at, where does that put me right down to the shorts, let's say? Oh, I'm down 1800. Well, yeah, that's a little bit too rich for me. Okay. Rich meaning it's too much of a loss if we went down, 70 points from 42.80 down to the shorts of 42.10. So, I've got, like I said, different measurements that I go over with the group all the time. And, we'd make, calculated assessments based upon risk and reward, pretty classic, not terribly complicated. But there's a number of factors that go into it, okay? And unless you're going to be expiring the trade, moving up this line is nice because it gives you more. Like here, if I roll these two down, it will bring me from basically no risk to the upside, meaning that it's flat no matter how far we go up. And this is now up, what's that, $240, $245, which basically means, and I'm saying, I mean, Tommy, but I'm saying to everybody,
It's like you're 1.5%.
Yeah. Okay. So it's like, and as long as it, if it does that tomorrow, but also you've got to say, okay, am I willing to take that amount of risk overnight?
Right.
And, and if I look at the market and say, okay, okay, I'm trying to move this out of the way. Let's see, I'm trying to move. Oh, there we go. If we take a look at the SPX here and say, hey, we had this big, we had a nice little up this morning, up about 42.88, kind of coming down. We're kind of sideways, okay? This is one of the reasons why I don't do, some people within the group will make adjustments fairly early because, as I tell people, everybody's responsible for their own adjustments. And some people might say, I really think we're going to be heading up tomorrow. Feeling pretty bullish. And if the market's down like this, then they'll make their adjustment, get a higher credit, move their expiration line up further, and potentially make more in the trade. I tend to be a little bit more, the trade is aggressive, but I try to make conservative adjustments within the aggressive trade, if that makes sense.
Mm-hmm.
And so one method that I use is I wait. And as we know, just take a look at what's been happening over the last hour of trading within the last few weeks. This has been very, very aggressive trading within the last, sometimes even the last 15 minutes.
Right.
And so, if you're making an adjustment and you're taking on more risk to the downside, and the market really goes to town on you, pretty late in the day, I like to wait. And I realize that I may sacrifice some of the, because as time goes on, the credit available in these, if I take a look at here and say right now to make this adjustment, I'd get $1.20. So 720 minus the $6, $1.30, $1.20, $1.25, you can see it's floating around, okay?
Right.
Well, there's no question that if the market sits here and at the end of the day, it's at 42.80, we'd be lucky to probably get $1 or maybe $1.10, maybe $1.15, okay? Because naturally during the day, the credit is going to start to wither away. Just the natural, evolution of these trades, because we only got a few days left.
Expiration, yeah.
Exactly. So you're playing against, well, Tom, you love this, it's like being in the cockpit, and you're looking at all your dials and you're looking at, okay, well, how much do I trim here? Do I trim this? What's my out, what are all the various things that I'm looking at to potentially affect the flight of this trade? Well, you got a lot of things that can affect this. And so, not to say that it's, and everybody's making their, their best judgment, their best assessment of what's happening, but you never know. Clouds can come in pretty quick. The storm can come in pretty quick. You don't know. And same thing with the trade. It's a perfect analogy in the sense that you just don't know. And so that's why the only way to really learn is by doing it a lot and, trying to use experience and know when to make the adjustments, know when to, get out of the trades. And even like last week, we basically spent a week out of all of our trades. I didn't feel comfortable after the FOMC came out on Wednesday, a week ago, that, we stayed out of the trades because, I didn't feel comfortable with what could have happened right afterwards. And, we had quite a bit of movement
to the
roller market.
Coaster there, yeah.
Yeah, and we avoided all that. We sat, we were in the dugout. We were sitting back with our feet up, watching the game, and enjoying what we were seeing and learning. And just we weren't sitting here doing nothing. We were sitting in the dugout, looking at the ball field, and saying, "Okay, can you learn what the players are doing out there? Can you make any kind of a assessment of what's happening?" And I think that's important. I think it's important for sometimes, a no trade is just as good as a trade.
Cash is a position, right?
Exactly. So anyway, without going into a lot, so for instance, our Dreamlifter trade, normally we put a 10 to 15 lot position on. Right now, I have a 1 lot on. And the reason was because I was very concerned about where we were with the rut. And well, actually, let me just, do you mind me switching to that, Tom, or?
Yeah, sure.
It'll be really quick here.
Yeah, while you're switching, I had a flight commander once who said the hardest thing about flying is knowing what easy thing to do next. It's kind of like with option trading. Any one little thing is fairly easy, but knowing what to do when is the hard part.
Exactly. So here we are with the Dreamlifter trade. Okay, and we're down what, about 11 points today? Okay, but I don't think we started like that. What did the rut do to start today? Let's see. Yeah, we went up. So we started when here was the close. So we went up to what, 2342. So yeah, the high 2342. So we're already 20 points off of that. Okay. So I was concerned that putting on the complete Dreamlifter and our construction of it, as I looked at this and I said, there's ways you can do things. And what I told the group was, one way that I'm going to play this is that when I need to make adjustments to this, so I'm going to start small and I'm going to basically leg in. And I said, if the market does nothing and it just sits there, I would have wished that I would have gone in full boat. But one thing that you can do is, this is like putting your toe in. And it's like, okay, I'll put my toe in because I'm concerned about, basically where we are, with the rut. And it's like, okay, we zoomed up here and it was like, okay, just like when we were over here back a couple of weeks ago, and I put on a bearish butterfly right around here. And I said, okay, we're probably going to take a little bit of heat because it's probably going to try to head up to the all-time highs here, which it did, but then all of a sudden it, backed off and then, oh no, back up again. And then all of a sudden, boom, there it went. So we got in here, I got out, I don't know, somewhere around here. And, we made, depending upon which one of the trades it was, I had like 3 different ones on, made anywhere from about 25 to 32%. Wasn't a lot of money. I just put a simple 1 lot on. So, made 150 bucks. So, it wasn't a big deal. But the point being is that when I look at the same setup again, it's like, geez, if you take a look at 30 days, I remember this from the old John Locke days, I say, hey, May 28th, look back a month, where were we back on May 28th? And, basically the low there was maybe around 2247. So we're basically what, 57, we're about 75 points up in the last 30 days. Okay. 2 days ago, we were up even more than that. Okay. And saying, probability, if we're up 80 points within the last 30 days, it's a pretty good chance, historically speaking, that we're probably going to, if you put on a bearish butterfly right now, you're probably going to do pretty good with it. Okay. So, what does this look like?
Yeah, it looks like a bearish butterfly.
Does it look like a bearish butterfly? Okay. So, a horse by another name. But, here's Dreamlifter. But I'm saying, hey, I'm going to start this thing off with what I think, and I could have put I was going to put a 2 lot on, and basically it would have been just delta 0. Okay. But I said, in my mind, I think, as we start to see, I said, I want the market to tell me what it's doing so that I know then, what's the market, as I think the guy from Shadow Trader always says, what's the market driven data? Okay. As opposed to you trying to come up with it yourself, the market's going to tell you something. And, when the market's doing this, okay, well, momentum is going down, various, average true range is coming down. It's like, okay, we're probably going to, be coming back a little bit or maybe going sideways, gee, are we really near the all-time highs? Yeah, we're within 20 points of it. And we got within 8 points of it just a matter of a couple hours ago, so, I think people got to look at this stuff and, take that into account and make some judgments and then put the trades on. And what I'll do probably at the end of the day today is see where we are and, make an assessment. And I may be either adding to this trade because obviously we want to get a little more capital in the trade. Usually we have, upwards of 15 to 20,000. So, but I'm not rushing it. Look, we got 32 days. We've only been in the trade 4 days. So, I read a great article yesterday about, patience and just waiting. And, the people that have the ability to wait and be patient, I think are rewarded. So, so anyway, so I'll be making potentially adjustments to this trade, at the end of the day today, depending upon what the market does. So there we are. So that's kind of that's the latest and the greatest with Flex and Dreamlifter land, Tom. But so far, since we've changed the rules for Flex 3.0 and going from Dreamlifter 80 to 40, all the trades within the past, since the beginning of May or something, they've all been winning trades. And, I think Dreamlifter were up like about 14-15% just in the last, 30 days. And with the Flex trade, we're up similarly. So it's doing, the last month or so has been doing, really, really nice.
Nice. And just since we have O&E up, I did talk to the support guys at O&E because there was a question. I think somebody asked me, I can't remember if it was a forum or not, but if you sign up for the trial, if you're a new user and you get that 15% discount and you do like a monthly and you want to switch to like quarterly or annual, do you still get the discount? And they said, yes, as long as the discount's still available, which it has been for a couple of years. So
I wish we could get the discount for people that have been getting it for many years.
yeah, I know. I just sign up with your wife's name, right?
Yeah, yeah.
There are ways, but
maybe they're tracking your IP address.
Well, just use ExpressVPN and just get an IP address in Australia or something. But
there's always ways, right?
There's always a way. I also had a call from Brian, who's the guy who bought OptionVue a couple of years ago. They're getting ready to relaunch their website. They're working on recoding the whole platform in, I think he said C++ and what was the other language? Maybe Python, I forget. But they're moving away from the Borland. What was it? It was a Pascal-based language that Len was using, but they're just kind of rewriting OptionVue from scratch. And I don't know how close it is. I think it's still fairly far off, probably next year. But
I'm surprised that they could survive through the time to do all that, and they must be putting in a lot of money.
Yeah, he's putting in quite a bit, I think. But his goal is to make it enterprise class software. OptionVue always had glitches where it would do things that weren't expected or the risk graph wasn't looking right. And he wants to get it all so an enterprise can look at it and say, okay, this is something I can trust and use.
Well, and they've got to become competitive with pricing too.
Yep.
Because they clearly are way out of the ballpark compared to OptionNET Explorer.
Yeah, they've kind of priced themselves out a little bit.
Well, yeah, and are there some things with OptionNet Explorer where there's some things that you can't get, like during the day intraday pricing, and can you go back, like right now, can I go back to 6:30, 2 hours ago and get the pricing? With OptionVue, you could do that. With O&E, you can't, because they're just collecting data and then they put it into their system overnight.
Right.
So intraday, you can't do that. But it's been 10 years since O&E has been around, and they've collected
when Andy was a student at Shared Mentoring.
Right, exactly. So they took on a strategy of developing software that will just collect information during the day, as opposed to OptionVue, which actually went out and purchased it. And
I think the thing with Andy is they wanted delayed data so it didn't cost them anything, or it was cheaper.
Right. And the thing is that for users, sure, OptionVue was really nice, but was it worth $2,000-3,000 a year, versus 600?
Yeah, and Brian said they changed data providers too, so they're doing big changes there. But it'll come up pretty soon, I guess. We'll see the new website and everything.
Yeah, so I think that we'll see what happens, but it's $50 a month as opposed to
I think OptionVue,
$200 a month.
If you get Backtrader, it was like $1,300 a year, I think, or $1,200 or $1,300 a year, which it's still quite a bit more expensive than O&E.
Mm-hmm.
Now, if the British pound keeps going up, maybe it'll get closer parity in price, but for now, O&E is still so much cheaper.
Right, exactly.
And I see there was some stuff in the chat from Thomas about the CME is going to delist the SPX options and futures options. And I don't think it's really going to affect anything, like Mark said in the chat.
But what
Most
was
of
he said? The CME group is going to what?
they're going to delist the SPX futures and futures options, the pit traded ones. I guess they closed the pit. I was reading the or the press release. They closed the pit in March of last year due to COVID, and they're just going to leave it closed. They're just not going to reopen that
Oh, is that right? So there's no more open outcry anymore?
for SPX, I guess. Yeah.
Wow.
So Wayne says, looks like it's going to be the same direction Rut did, all electronic. Just be more careful with the bid ask. Might not change anything though.
Yeah, I didn't know the pit closed. That's interesting.
Yeah, I guess COVID, right? Can't all
Well,
hang out together.
well, I remember about, I don't know, what was it, 10 years ago, maybe 11 years ago, when I went to the pit there in Chicago. And this is when, Dan Sheridan had one of his,
At the reunions.
at the reunion, and it was really cool. I mean, to go in there, and I remember seeing the whole, I mean, it was pretty amazing to see the whole pit working. But then I remember going off to one of the sides, and I was like, oh yeah, there's the Rut over there. There's one guy sitting there with his feet up, looking at a magazine.
Right.
Yeah, that's the Rut guy right there.
Yeah, I was actually on the floor in 1982 trying to get a job as a runner.
Really?
I was going to school in Chicago. That's where I grew up, and one of my teachers in a night school class was a market maker. So he got me interested in options back then and tried to get me a job, but bear market, nobody's hiring. So finished my degree, flew for the Air Force for 20 years, and then, but he lit a fire in me with the options back in '82. So
Wow, interesting.
yeah.
Yeah,
And
I wish I.
Mark Ansel says most CME markets abandoned pit trading a few years ago. No significant reactions afterwards when they became electronic trading. Yeah, I don't think most people really notice it much, to be honest.
So anyway, so that's pretty much all the Flex and Dreamlifter stuff, Tom. So pretty much, so we kind of got off on other tangents here, but it's like I said, since we've changed things around, I don't know, I guess it's about almost a couple months ago now. Been very.
It's going well, yeah.
It's been really going well, and hey, we'll just take it as they come. Not getting greedy, or like I said, things are going well, but we decided to take a week off just because, sometimes you do that because of, if there's, just like we took the Dreamlifter trade off, I think the day before the FOMC meeting, and that was a really, again, it was, could we have made more money? Could we have made more money the prior week with our flex trade if we would have held it in towards expiration? Yeah, it would have been like a grand slam. Okay, I mean it literally stopped just above the shorts. I mean,
right.
That's only in dreamland that you see that. But I was talking to my brother about this, and he said, did you see where the SPX, he says, you absolutely like nailed where you had your shorts with the trade. I said, yeah, but no one would have taken the risk of overnight, because if we went down, 120 points, the trade would have been down like $15,000.
Right.
And it's like, there's no way. So we took our small win, took our, bat and ball, and went, took ourselves out of the game and said, that's good enough. It's the old, you don't have to, people who have these pie in the sky saying, well, gee, if you would have only known that you could have just held on to it, well, sure, that's fine. But, I don't have the,
you just need tomorrow's newspaper today, right?
Well, of course, I mean, if we knew that, we would all know what to do, right? And and none of us would be here talking about it.
But then there wouldn't be any premium either. So.
Right. So.
All right. Well, hey, thanks, Dave. Really appreciate it.
Yeah, you bet. Yeah.
And Bruno, I see you're here. So welcome. It's nice to see you again.
Hi, Tom. Can you hear me?
I can, yeah. And it'd be great if we could meet up when Gabby and I are in Belgium. We're looking forward to that.
Yeah. I'll probably be around. As I told you, I travel back to France because of my mom every 6 to 8 weeks. So yeah.
It's about what we were doing when we were in Germany. So I understand.
Yeah, at least compared to South Africa or Mauritius, Barcelona is just a quick flight.
Yeah,
So,
it's not bad.
yeah.
So how are things going with you and Rhino trading and prop trading and all that stuff?
Well, I presented my evolving conservative Rhino about a month ago, or 6 weeks ago, and I'm still trading it that way. Very conservative, sleep tight type of Rhino. Probably not very exciting for many, but it's okay. I'm happy this way because I've got so much work let me share my screen. Yeah, I suppose you can see something.
I can see something.
Okay, so this is the July Rhino with its way out. Generally, I start scaling it down. So now it's down to less than 10K. Because of course, with the lower volatility, I have to keep my trades a bit longer to theta is slower to come. So, and especially with my conservative type of Rhino, it's OTM, but I mean, it's okay. So this one, either I close it, or if I'm too lazy for it, as I said, doesn't use much money. So I may just wait for expiration. So I'm doing okay. The August trade is not fantastic. I was looking for opportunities to build it up, and nothing was coming up. So, but at the same time, my mandate or my brief is to reach about 2%, 1.5 to 2% Reg T. So basically, on my planned capital, that means my target is generally $800. So this one I can build it up a little bit longer. Again, lower volatility. The building up is slower, but that's still okay. So my tent or is 344. So I've got a little bit more to do. But I don't add a lot of capital, because adding a lot of capital when volatility is down can be treacherous. So I want to make money, but using as little as possible. So and also because of my substantial PM account, I can use leverage now. So I'm using a 1.5 leverage. So if I get my $700 to $800 times 1.5, I mean, that's, I make my boss happy. So it's okay. I'm generally, I'm on target for my performance for the year, which is about 25%. So except I've got a little bit of a thorn on the side, is that I have started buying VXX, and now VXX has fallen. So it's I mean, I don't mind that ongoing loss. I mean, there will be a spike and I'll get my money back, but it's a little bit of a frustration. But yeah, I mean, at the same time, it's quite comforting to know that if we have not, I wouldn't say repeat of last year's crisis, but a big correction, it's nice to have some hedge in the market. And because I don't want to repeat the same mistake of keeping that VXX position for a long time, I got myself a book. And if you know me, you know that I love mathematics, and I'll delve back into Gauge. It's actually a very good book, and I can recommend it. And then from that, I mean, any quant knows that Gauge works well to model volatility. It may have some difficulties picking up change in dynamics when volatility is very low, but even though people talk about a vol implosion, VIX being down, etc., but I mean, VIX at 16, that's still around or even slightly above its long-term average. So volatility is still good. So I built a model on Gauge, and here you see the VXX. And VXX is, the problem is that, well, when you buy it here, just when the vol spikes, you can make a lot of money, or you can hedge your position very effectively. The problem is now, when nothing happens, then it sags. I mean, it's awful. So I used Gauge, and my Gauge model is a very simple model. I mean, the mathematics is complicated, but I mean, there's no technical analysis. There's absolutely nothing. It's just straight math. And the gray line is my VXX model using Gauge, and I've done just I wouldn't even call it a filter. I just check the dynamics, and when the no, so it's not a gray line. It's the VXX model, the long equity, long VXX is the blue line. So I try and lose as little as possible when volatility then drops. So my long vol trade is doing okay, and I thought, well, why not just when VXX starts falling? I mean, yeah, I shouldn't even say that because my system does not even look at VXX. VXX is just the instrument I trade. The model only uses SPX as input. It's nothing else. So there's no analysis whatsoever of VXX. So the blue line is my long VXX when the vol regime is picking up, but trying to be out of the market as much as possible. But at the same time, you want to be back in if there's any little spike. But at least it's doing a good job, not losing too much when volatility drops. And then I added the converse, basically when also using Gotch. I now also when I get the right conditions, I buy SVXY, and that's my orange line here. And the combined equity is the gray line. So the gray line is basically based on SPX Gotch, long VXX or long SVXY. And I'm pretty happy with that. Only have 3 years of data because VXX only exists since early 2018. I did check with data sets half the size and then full size. It makes no difference. I assume that of course the big spike last year can actually distort the stats a little bit, and I would assume as well that I would be more confident using it again with VIX at a sustained level, maybe above 14 or 15. I'm not sure. I mean, I would probably switch it off when volatility is too low. Or maybe I would go just the short equity side, which is basically the longest XVXY. So this is combined, and maybe I will have to, I'm writing a bot at the moment, and maybe in the bot I will switch the long side or the short. I mean, the short side, or basically long XVXY, seems pretty linear, and actually you can even put on a little bit more leverage on when the VIX is down. So this one is looking good. So you can actually push up the leverage on the falling volatility. And at the moment, I'm using three SVXY for one VXX. So, and I forgot to mention, it's a 1 hour automated system. As I said, there's no optimization, no calculation. Once you've calculated your Gotch, I mean, it's just plugging in the figures in an equation, and that's all. Yeah, it's surprisingly or amazingly simple. So now my next step is to have my automated bot going and sending orders directly to IB, and that's it. But I'm pretty happy with my egghead Gotch calculations.
It looks good.
Yeah, it looks okay. Yeah.
Hey, whatever happened with your software project with that programmer in France?
Well, he ran out of money and he gave up. Yeah.
Oh, he did.
So
it's a shame.
when I have time, I think I would. I'm rewriting all my sub software in C#. I would need some help, and then and it's going to be a community thing, you know. I mean, cheap or open source or SourceForge, or maybe some crowdfunding. I mean, but I don't want to make it a commercial software. I don't have the time for it. So, but all the tools are already there in SOAP. It's working well. And I'm using this opportunity to rewrite everything in C# to make it look nicer. But again, I'm a math guy. I'm not a UI type of guy. So I would definitely need some help. And I'm really short of time. Yeah.
If somebody in the community is a programmer interested in helping you, would that be something you'd be open to?
Oh yes, definitely. I mean, to people in my group, there's a soap section in my Slack group, and I said, well, it's going to be open source type of thing. If anyone wants to build on it with me, I'll give away the source code. I don't have any problem with that.
All right. Well, I'll make a note in the forums for people in case they didn't catch this recording.
Yeah. Okay.
But things are going well otherwise.
Yeah, very well, very well. Oh no, something is not going well. My birthday was last week.
Oh no. Well,
Yeah.
happy belated birthday.
Thank you. But I'm feeling very old. Yeah, yeah,
Well, we're all getting there. Can't stop it.
yeah, yeah. But anyway, as long as my brain keeps going, I don't think too much about old age. Yeah,
Yeah. It's a state of mind in some sense, but
yeah.
sometimes your body doesn't agree.
Yeah. Anyway,
Oh,
so I will keep you posted on this VXX thing because it's looking very good, and the fact that it is so simple. I
so
mean,
it kind of big picture, how does it work?
how does it work? I mean, it's automated. I mean, it's going to be a bot now. At the moment, I'm using Excel to do the calculations and send stuff to IB. It's pretty messy, but now it's going to be a standalone bot. 1 hour charge. You just need SPX, and it buys VXX or closes VXX positions, goes into SVXY, closes the SVXY position. That's all.
Okay,
No setting. That's a good thing. There's absolutely no setting.
that is a good thing.
Yeah, yeah.
And Mark says any birthday that begins and ends with you breathing is a happy one.
Yeah. Anyway, I've got to get back to my trades. So, but I thought I would just pop in, and I don't come here too often.
All right. Well, again, thanks for stopping by, Bruno. Always a pleasure. And Gabby and I,
Yeah,
like I said, will be in Belgium
yeah. We'll keep
middle of
in touch.
August. Yeah,
Definitely,
great.
definitely.
We'll go meet up
Okay.
at West Vleteren again.
Sorry.
We can go meet at West Vleteren and have a beer.
Absolutely. Anything
Uh,
strong after looking after my Alzheimer mom. Anything strong.
Yeah, that's a pretty strong one. I think it's
Yeah.
over 10% if I remember correctly.
Okay, that's my remedy. Yeah.
There we go. All right. Thanks, Bruno.
Okay. Thank you, Tom.
All
Okay.
right. We'll see
See
you.
you. Bye.
And Mark mentioned any power user who seeks a challenging project. He's looking to kind of automate some of the stuff he does with Night Owl. So Mark has his email address in there. I think you can also use Night Owl at Aramir too. I'll just put that in the chat. So either one of those will get right to Mark. And let's see. I think I see Wayne. So hey, morning, Wayne.
Good morning.
Yeah, I haven't told you yet, but I'm working on that member site for the Sleepwell folks, and I think I'm gonna do this for all the different trade alert services, have their own dedicated um, like member site on a separate server. So when we had that server kind of issue with the hackers a week or two ago, that'll kind of mitigate that. It'll be like a completely separate place where you can get all your stuff. But that's coming along.
That's awesome. That's really that's exciting.
Yeah. And so how are things going with you and the Sleepwell?
Oh, actually, just doing good. We're plugging right along. Yesterday, everyone everyone kind of blamed it on the FOMC meeting and everything like that, but we are starting to have some like a macro backdrop that's starting to just kind of signal some issues. Nothing's actually creeped up yet because the assets really just haven't confirmed it 100%, but we are getting a little bit more traditional, 60-40-ish looking. Um, and once that starts happening, it just it's a little bit more risk is building into equities, and then we'll see how it ends up turning out. Sometimes it just kind of flows away and everything's all fine and dandy, but it is quite interesting, when we've got an earnings yield of around 2%, and then we've got a growth yield of around roughly the same, around 2%. So you got 4% expected future returns in stocks, and then you've got around 2% in the 20-year bond that people are pushing into bonds. That's an interesting move that's been happening. I was looking at history and stuff like that. It looked like we would probably not get a push into bonds until probably another 6 months to a year or so, and it looks like we're kind of doing it a little bit early, but we'll see if it's something that's sustained. So yeah, it's just kind of playing along. But I mean, anyone that follows the sleep well portfolio is kind of seeing that we're slowly shifting risk around. We definitely phased out of inflation assets. So like the models are seeing very little to no inflation, or at least a slowing of inflation from this point out in the medium term and short term. So in fact, we're close. It's not quite there, but we're close to actually starting to signal a deflationary pressure, and that'll be a very interesting thing when bonds are going up really heavy, and then we start to get a deflationary pressure on the dollar relative, right? Not saying that we have deflation globally or anything like that, but relative deflation pressure on the dollar. It can cause some fun times in the markets for sure. So Dave's bearish butterfly might have fun.
So you're seeing basically little or no inflation projected, but the interest rates seem to be headed higher.
Yeah, it's well, wait, which interest rates are you talking? Short term or long terms?
Well, we had those plots like last week, I think.
Mm,
I don't know how was that a year interest rates or long term? I don't know.
yeah, I mean, so anytime like when the Fed came out and kind of spoke a little bit, we had some bops in interest rates and stuff like that, but the short terms actually came down, which was bullish for bond yields for the long term rates. And so, um, that can be kind of said where there's lots of reasons, right? And I definitely don't know them all, but
No?
man, I wish, I wish I could plug into the matrix and just to get it all, right?
Hey, I
So,
take my blue pill every dinner, so I stay out of the matrix.
oh man, I see. I'm a red pill guy. So, yeah. The one thing that we could say is that when we have long-term targets for the Federal Reserve, long-term yields right at where long-term bond yields are, they're pretty much already priced in, right? And so they can move downward with relative ease compared to like anyone that's been following the sleep well or been listening to anything that I've been saying since the COVID thing. We were well below the targets for the long-term yields after the whole COVID debacle in 2020, and so there was pretty much no room for yields to go down anymore, at least long-term yields. So they were going to go up. It was like almost like a surefire thing, right? Like just load up on them because they're all going to fall. And but now once they started getting to those Fed long-term targets, it can now bounce up and down pretty easily. And so that's maybe one reason why we started to see them fall, and they're starting to move around and stuff like that. But demand on those bonds will now show up in something like an ETF like TLT, like what we use in the Sleep Well portfolio. So which is nice because that does mean that we can diversify away from the risk in equities relatively efficiently without being like fighting the Fed, basically. That's always a good thing.
There's a couple of comments in the chat. I don't know if you can see it from Thomas.
Oh yeah, I guess let me see that. Worry when 30-year bonds and SPX have same vols.
It's not as it books at university.
Yeah, I don't know.
Look at the 30-year
SPX
bonds
vols.
and SPX vols.
So stocks are safe and bonds 30 years are risky. What gives? Oh, I mean, 30-year bonds, stuff like that. I mean, that's that's always a fun topic because I look at 20-year bonds, but 30-year bonds are relatively newer, and so but basically, yields in the markets versus what yields are in bonds have always been something that you look at. So, or that I've looked at. So, like you look at, earnings per share, convert that into earnings yield, and then you look at what the 20-year is, right? And that's kind of your quote unquote risk-free rate, or you can subtract growth out of that, business growth out of that, and kind of get our risks even. And I do that with a 20-year, but some people do it with a 30-year. Now that the 30-year is there, so. But I mean, as far as I can't really speak much to them being at the same vol and all that. I mean, really the risk in bonds. I mean, yeah. I mean, I don't look at risk in bonds through a volatility lens, and so that might be why I don't see the kind of quote unquote the same risk. I look at the raw yields and the overall macroeconomic environment for what's happening to yields and what the alternatives are. So like if we look at stocks, like I was just kind of saying, if we look at stocks and we say, okay, we've got 2.2% yields on earnings, and then we've got roughly over the last 10 years, we've got maybe 2.1 or something business growth, or over the last 10 years. So if you combine both those together, you got basically 4%. And then when that risk premium changes, so like all of a sudden yields start to go up, right? And then on a relative basis, looking back, if yields start going up, then that means that stocks are then overpriced for what they have been, right? So what's going to spur that? What's going to sustain that? Are we getting accelerated growth? Are we getting accelerated, earnings and things like that? Or are we getting accelerated inflation, right? And if we're getting accelerated inflation, then that's okay. So that's sustainable. If we're getting accelerated growth, then that's sustainable. But if we are having deflation, or we're having decreasing growth, and bonds have also rose in yield, and so it starts to change the risk premium, so that starts to make equities a little bit more risky. And so I kind of use bonds as a base instead of looking at bonds as like, hey, how risky are bonds? Because I look at bonds as kind of more of just a parking spot. I don't know if that answered any of that, because I think that you're asking about some things that I'm just not completely up to date on as far as the 30-year bond.
All right. Well, the Fed is tapering the 30. And,
Yeah, I mean, it's not a huge position, but yeah, I mean, they were doing it with corporate. I mean, this is all really common when we start to get rising growth and rising inflation, which the models are starting to curve the other way. But when you get rising growth, rising inflation, you really do get a really hawkish Fed, just because I mean their whole job is to make sure the economy isn't overheating and stuff like that, and make sure that bubbles don't form. And I know that that's a fun topic, like whether things are bubbles right now, but if you look at the alternatives, unfortunately, it's not all completely bubbled up yet, even with PE ratios at like 45 or something like that. But it has definitely disconnected from the intrinsic value of stocks, though, which is unfortunate.
right.
So, but yeah, the tapering is going to happen. It's nothing like they're raising the short-term interest rates. That's going to be a big deal. Whenever they start doing that, that's kind of a big misnomer. But I mean, yeah, anytime the Fed's starting to drop off some of their assets and starting to drop QE. This happened in 2010, if anyone remembers 2010, after 2009's run up and everything like that. And that was the end of QE1. And for those that remember it, or some of those that don't remember it, we ended up having a flash crash right at the end of QE1. And then we started QE2 at the, when we were down and everything was looking pretty scary. And then that took us all the way to, I think, right before the debt crisis, and that was the end of QE2. And then we had another crash. So it's something to note that when the Fed starts to stop their QE purchasing and stuff like that, that can cause some problems.
All right. Well, we're kind of running out of time, but I did want to remind people that the sleep well is going to bump up the prices in July. So it's going from 50 to 60 bucks a month. So if you want to lock that in, now's a good time to do that. and the performance has been good. It's been a little flat since maybe April, but that's normal. Remember, the sleep well is more an investor product. You need a little bit longer time frame, time horizon. It's not a trader product. But it's a good place to put your cash with low risk, decent return. So anything you want to say on that, Mark or Wayne?
Yeah, I mean, we've always been excited to have it, and we've got a good group that's in the sleep well right now, and we've talked to more people, and there's a lot of there's a lot of money managers that are subscribers, so it's always nice to see that it's been taken up, and people have really liked it, and it's a good. Lots of people have had great feedback about where they put some of their extra cash that's not being traded in strategies, and the uncorrelation. So like Dave Thomas, his trades, they perform well in different areas and things like that, and so it's really nice to have something that uncorrelates and kind of is winning when other things aren't winning and things like that. And so we've had just lots of good feedback, and the service has been growing. Tom's been working really diligently on getting the online platform more user friendly and easier, and so just with all that work and everything like that, it's just merited a little bit of an increase. But anytime that you sign up, you lock in that price forever. So if you get it now, you lock it in. If you get it after when it's 60, you'll lock it in then. And then that goes for the quarterly and yearly subscriptions as well. So we're just really excited to keep continuing building the product, and it'll just keep getting better and better, right, Tom?
Absolutely. There's plans to add the multi portfolios and risk graphs and all kinds of stuff. But yeah, that price increase is coming soon. So if you're interested in it, people have been pretty happy with it. Go ahead and aramir.com/sleepwell, and I'll put the link in the recording. So I just want to remind people of that. And with that, we're kind of out of time, so no roundtable this week. So everyone have a good week trading. Watch your risk. Markets are at all-time highs, so a little frothy here. So just make sure you're not overexposed to the downside. And we will see you all next week. So thanks, everyone. Really appreciate it. And yeah, we'll have a good meeting next time, I'm sure.